following is a presentation of TFNN. The Global Market Pulse with your host, John Logan. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, John Logan.
Hi, guys. Welcome back to the show. Good to be back. And we're going to take a look at the Australian dollar and the Japanese yen immediately. Here's the Australian dollar. Economy growing faster than they thought it was going to grow. And that bodes well for a currency, generally speaking. Talked about 73.42 up top being the targets here, and that 71.69 down below, stops down below. That's still the case. Nothing's going to go in a straight line, folks. But again, looking at the kind of guidance system on this trade, all we've got to lean on really as something to look at when it comes to stops and trailing stops. The 240, 72.57 now is going to be short-term support on this. Again, don't see a lot of problems with this reaching the goals, actually. Alternatively, looking at the Japanese yen, a couple of things going on with that this morning. Not in a good way, not the way I thought it was going to go. Had, a little bit more exposure here than what I thought to fundamental news right now coming from the, what's his name? Abenomics, the Prime Minister of Japan. Going to defer a sales tax for another 2 years. Talked about the targets on this being that POC, next stop up 111.78, reached 111.45, didn't quite get there, but you can't be real, greedy on things like this. We had come up from 105.50 up into 110.40 and talked about this crowding, wanting to possibly do a little bit of a bust a move on the upside. And yes, I grew up in the 70s and the 80s, bust a move, if you remember that. Oh my God. Okay, so we've broken down. That's where kind of stops need to be oriented here below 110.40. I'm not a big fan of going short this product, but here's the 110.40, 110.35 that we talked about. We were going to use as support, but this is another great example, actually, of letting trades breathe. In this case, on the yen, 105.50 up into 110.40. But, when we have situations where we can, be stingy on protecting that type of capital on that type of move, that weekly unfair high weekly unfair low coupled with the daily unfair high. I'm having my headset attack me right now. Find a way to raise your stops, and this is a situation there. So again, no trade, all trades are not going to work out. And as I would say, in the spirit of Trump, I'm going to tell the Japanese yen to get out of here, get them out. We're getting the Japanese yen out of the long camp right now. It's so sad how I attempt to have humor on this show. So let's go back into the S&Ps. And first of all, we're going to hit the dollar. Dollar yen. This is kind of the way the puppy. The ball runs. The ball rolls. I have no idea what I was getting ready to say right then. 95.53, that was support on this. This is getting a little bit too much breakdownish for me. 95.65, 95.53. Very similar to the yen situation when we were at inflection points up top. Talked about this thing probably not wanting to stop here. I didn't see this reversal coming to this magnitude, but again, these are what stops are for. Again, not a big fan of shorting this. just like the yen trade. Not a huge fan of shorting that, but again, we've kind of poked our head up above inflection points, just like the yen trade. Here's the dollar, and now we've come back down below. Now it's not exactly okay to be long anymore, just like the yen. So this is a situation. Now it's kind of an okay to be short, not okay to be long. But again, this is kind of a no man's landish type situation, and I'm not impressed with it and not exactly excited about going short. So this is kind of a leave it alone situation. 10-year, man, what a cool trade this has been. Market came off slightly yesterday, and I think this morning, what are we trading at on the S&Ps? 2089. And let's go to the S&Ps really quick before we talk about the 10-year. Here's the chart on the S&Ps. Here's that 2083.84 number. We reached a low yesterday and last night of 2086. And again, you know, this is really the type of action you want to see from the long side. You want to see some backing and filling every once in a while, and you want to see these support areas hold. I'm not telling you to back the truck up and go long right now. I'm just saying that we spin around up here a little bit, consolidate above these inflection points. This is not an attractive situation for shorts. Not be peeing in my pants. If that type of action happens, we don't know if we're going to spin around up here yet, but if that starts to happen, there's going to be some people getting a little concerned that are on the short side, and they should be concerned, because that type of action means, you know, people are trying to cover their shorts when we come in. Some people are sitting on the bid. I mean, it's just not a, and we've had a big move up lately, so you've got to just kind of pay attention to that. I need a break here for a while. All right, so let's take a look at the 10-year. This was the really attractive situation, these higher lows. We talked about this a lot. Placing long-term stops below 129. Not so convinced that, you know, the Fed, whatever they say, is going to affect this thing now. I mean, this was a full-on onslaught of fundamental bearish news that the Fed has recently put out. And guess what happens? 10-year goes sideways, market goes straight up. 10-year can't go down in the face of fundamental news and technical reasons it should go down relative to the U.S. stock market, and somewhat of a, you know, thirst for stocks, non-thirst for treasuries. That this has been, wow, just a nice little situation. So we haven't reached our targets yet. 130, got a couple of ticks left. In my opinion, you know, that's going to be your initial targets right now. If the S&P spin around up here again, you know, you might have some problems with the 10-year if that thing goes higher. But when I say problems, I think worst case scenario is, you know, we might continue to spin around and go sideways. If the S&Ps really break out, like Steve Banger was talking about yesterday, you know, you got some FOMC stuff coming up. You'd like to see the breakout above all-time highs before that meeting. How does that affect the 10-year? How does the meeting and what he talked about yesterday with yours truly affect all these components going on? We're going to talk about this a little bit more when we come back, folks.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile-based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com. Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. John takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi guys, welcome back to the show. We were finishing up with a 10-year, and we're talking about how the market. Steve Banger and I were talking about the other day. It might have been yesterday, in fact, actually. Excuse me. Market, FOMC minutes coming. Market kind of internals had turned positive. We're above some long-term inflection points. We're kind of spinning around. If we march forward and move higher before these next announcements, Steve was saying, that's kind of like sell the news type situation, possibly like the old days. And might have a really good opportunity for some short plays. It's not going to be a free lunch for anybody just to sit on the short key right now. We're probably going to have to run some people out before any turnarounds happen. Remember that. And if that happens, the 10-year may say, oh, wow, we are finally making new highs. The Fed is stepping in. Everything's going to work out, and the guy's going to get the cheerleader at the end of the movie, and the United States is awesome. That could drive the 10-year down. So be aware of that. I mean, these are kind of trading opportunities as I see it right now. At some point, the 10-year may give it up. Tom will probably say the same thing. I mean, there is a time at some point when you can't turn the rents the same way. We may be approaching that. So we may have a little bit of a blip on the screen on the downside at some point soon. I'm not getting completely married to these 10-year longs. These are just kind of, as we see them, relative strength trading opportunities. And Tom's not responding to my comments. So he's not watching my show again, which is interesting because we had a pact that he was going to watch my show every day. I'm just kidding. All right. Gold. So, it's awful when you can't stay up 24 hours a day trading. And that being said, Sunday night, Memorial Day weekend, or Monday night, excuse me, we had some lows on gold around 1,200. I want to point this out. You guys know this. This is the August contract. Hit the 1201, And I talked about the whole number. No mystery to anybody. These psychological numbers are pretty big, and there was another technical reason for this. But we've had a $20 an ounce move. We've also got now some new inflection points that are probably going to appear tomorrow. If we stay in this kind of scene on the bounce here, inflection points being a new balanced area. And you've got a pretty wide profile here on the August contract. 1230, 30 and a half is going to be a big deal here. You've got support 1200 down in 1193. I'm not a big fan of being short gold right now. So again, looking for areas of support. The previous month contract I know looks a little different on the profiles. We have to go with the front month and what the activity has been. There's not a lot of backwardation or front month new crop versus old crop situations in gold. We could use a continuous contract on this, but again, I've just had some issues using continuous contracts to build profiles in the past, and we're just going to stick with the front month. Okay. So that's the situation on gold. What do you do with gold moving forward today? I think 1230 and a half is going to be the lid on this right now. So okay. So that's the sum on gold. I think we're going to probably have to wait and see, find some inflection points here to find new higher support on gold. All right. So we talked about the S&Ps. Let's just hit the NASDAQ really quick before we get into some individual stocks. Okay. So the NASDAQ obviously, wasn't God's gift to the long world for a while. It was that relative weak trade relative to the broad S&P index. Getting back up into this area, this is kind of similar to what's going on with the S&Ps, a little bit weaker, that 2083 on the S&Ps. Here's the 4508 we talked about, a little bit of a resting point here. Still not the strongest sector. And you've also got a new profile attempting to appear here, which is in the scanner. Let me get my scanner started here, log me out. And let's look at the internals of the NASDAQ. And this is a type of situation, a lot of people, this is not a true arbitrage. And don't, again, if you've never traded this, you need to really kind of demo trade it for a while, what I'm getting ready to tell you, because it's not a true spread and this thing can widen out significantly. But if you're looking at something, like a long S&P trade versus a short NASDAQ trade, kind of an intermarket spread, but not really a spread, just kind of a relationship trade there. I think you've got a pretty good, as Tom would say, expansion of price in the NASDAQ. I don't think this is the sector that's going to lead the S&Ps up. I think you've got a little bit of an opportunity here on the short side versus S&Ps on the long side. You might want to just put that on the grid. eSignal actually has a great spreading piece in here, just like Daryl Martin has said many times. If you got other programs, it's a pretty easy spread to track. It's S&Ps minus NASDAQ. But what you want to do on the trade is you want to monetarily balance it out right. So if you just, you're short one NASDAQ and long one S&P, that's not necessarily the equal monetization on both sides of the equation to kind of balance it out right. You just have to say, okay, one contract of a NASDAQ's worth and the tick size is this, the amount of money is this, and then balance it out with the S&Ps. You can do the math pretty easily on that and, figure out the balance point there. In Chicago, we used to do a pretty cool trade that involved a lot of scalping, which was S&Ps on one side of the equal sign and NASDAQ and Dow on the other. So S&P equals NASDAQ or Dow plus NASDAQ in some type of ratio. And then that balancing act with those three products was an interesting trade. And it was a very profitable trade for a while, but just as all arbitrageable trades, at some point, a lot of people get hip to it, and it's not special anymore. And then then you're trying to squeeze a small amount of juice out of it, and every once in a while it rapes you for $1. So again, you know, these are not true spreads. Sorry to digress there. When we come back, we're going to look at some of the breadth calculations on the S&P and the NASDAQ and look at some of the internals and try to find some opportunities here based on the scanner. We'll be right back.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you, like it does me, call 1-855-750-4051 to find out what they can do for you. That's 1-855-750-4051. Call them today. Everbank is a member FDIC and equal housing lender.
Until recently, it was almost impossible for the average investor to hedge against currency risk in Europe or Japan. For a bold trade on Europe or Japan that protects against moves in currency, trade HEGE or HEGJ, 2 times currency hedged leveraged ETFs from Direction Investments. Visit directioninvestments.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, guys, sorry, a little bit of a technical glitch there. We were talking about the scanner. Can you guys hear me? That's my fault on my end. Okay, cool. Great. Thanks, Tammy. Tammy, thanks so much for getting up so early, by the way. Nevada, Las Vegas, that's where you're at, right? Reno. I should read your den notes there. Amazing. Thank you for getting up so early. All right. So as we look at this, we always look at the breadth calculations when we get to some inflection points, like 2083, namely this weekly one. As you look at this, as you look at the NASDAQ, and I'm just going to go right into the S&Ps, and we're going to look at the internals here. And guys, we've done back testing on breadth crossovers, and we've done back testing on overextensions. We've done back testing on middle grounds, and all the things I just talked about put together. When you and so an automated trading system, I'll just be honest with you, the only times that we like to really enter trades are around, daily unfair highs, unfair lows, weekly unfair highs, unfair lows, sometimes 240 unfair highs, unfair lows. And what does that mean? That means that we're looking at the leverage points for the entries of the trades around the envelopes of these fair auctions or balanced areas. So, and the answer, Larry, when I'm going to write a book is when I am qualified past a 8th grade education, and that hasn't yet been qualified, so we're still on hold with that. As we look at the last crossover on the daily at or around the 23rd or 24th of May, it's not necessarily a sign where, okay, it's time to go long again. The middle ground's doing what it's doing. We've had the internals crossover. You want to also be aware of, in addition to the internals, where that index inflection point pattern is. And what do I mean by that? I'm going to go into the E-signal charts really quick, or actually I'll just go into the scanner charts. Let me pull this up. As you can see, a little bit of a breakdown on sell structure this morning on the lower term time frames. What does that mean? That means we're getting below profiles on the 1 hour and the 4 hour. But remember, if you don't watch this show a lot, I always say this: long-term inflection points take precedence over intermediate over short-term. So as you look, going back to what I was originally talking about, which I'm amazed I can remember back that far, the internals are just a part of the equation. These longer-term inflection points are where you say, okay, well, we're coming up into this 2083. This might be a trading opportunity to look at this from the short side if we're coming up from below. All right, that the internals are saying, wow, we've got some issues being short here because everybody's happy. And you obviously can look at some of the leaders in some of these indices, but as we have a weekly close above, these internals are what they are, and then we're pulling back into these inflection points. It's not a situation that looks extremely rosy for the shorts to try to take any chances ahead of time. What you're doing is you're saying it is what it is, and that's one of the hardest things to do as a trader is kind of shed the stubbornness or, sometimes just your opinion on where you think the market should be. Technically, we have broken out, right? And we are sitting at a situation, for the past, I could go back in time on E-signal and give you a couple of dates, but we are compressing up into this thing, and I am completely shocked that we've done this, but it is what it is. We're backing and filling a little bit. You've got some support at 2083, down into 2073. You got to keep your eye on these internals, and I don't think there's any real valid long-term reasons to get short based on these internals and this setup until we start breaking down and maybe even having a weekly close below that DMZ 73 to 83. Now, a lot of folks will come in here and they'll look at the 60-minute breadth crossovers and just trade long or short based on that. And it's a nice way to trade, but you still have to be aware of those futures index inflection points, if you will. Tammy, can we do the TFNN traveling tour through Reno? Because I've really been wanting to get in an RV and put the office in there and do some transmissions from the road. Man, I hate airports. I don't know if you got, I get the hives every time I think about going to the airport now. I mean, having a huge RV with an office in it, traveling. Maybe we stop at a golf course every once in a while, Larry. I'll meet you there. So that's the situation on the S&Ps. And, you know, you're given all these inflection points. You can look at, you know, kind of the DMZ, if you will, by looking at these, you know, areas here. There's the 2083, there's the 2073. As soon as I tell everybody this is the flat out long opportunity ever, it'll tank. But again, you're playing odds. Not everything that I say is going to always come true. All we're doing is saying, you know what? You know, I've seen, for starters, you know, we've seen general technical actions and how they react as these technical actions are happening. And hopefully in the future, Larry has, you know, just an incredible wealth of knowledge who's on next and will give you some opinions based on just kind of seeing that movie before and understanding how, you know, people react when these type of events happen, technically speaking, you know, what these kind of chain of events may allow you to have some kind of higher probability to trade on moving forward after these events happen the way they happen. That's kind of what we're doing on a day-to-day basis. We're looking at some of these things from a purely technical basis, and we're also saying, you know what, these are the shorter-term trader reactions to those type of events factored in. So the reason I'm saying that is, you know, as these markets have moved up and really shocked everybody, and the 10-year's kind of been sitting there, and the FOMC information has not really jived, you know, with the 10-year action, there's a lot of things in play here. We talked about an explosion of explosion movement one way or the other a couple of weeks ago, talking about buying a long strangle. Now this event's happening. We're going to talk about this a little bit more when we come back on, you know, where this all may head.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software
software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com. Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Hi guys, welcome back to the show. So I was rambling about the S&Ps and all the different ways you can attack this. Bottom line is long-term breadth is consistent with our intermediate breadth. If you go into this TAS says button, by the way, I kind of talk about this on an automated basis. We spent a lot of time on this. If you never looked at it or didn't even know it was here, it's kind of a cool feature, in my opinion. It says long-term breadth coincides with your intermediate breadth. Both are positive for long-term. Any retracements into 2083 from above be looked at primary long-term support as long as weekly test breadth stays positive. Secondary long-term support is still at, that's way down there, but that's the bottom of the profile on the long-term. For the intermediate term, any retracement into 2073 from above looked at as good, blah, blah, blah. So bottom line is, this is basically the support mechanism as long as these breaths stay relatively positive. You're not, trying to pick tops and bottoms is a scary game. Let somebody else fight that part out. Getting confirmation. A lot of times people are like, well, God, why didn't you tell me to sell it higher? Now it's lower. You're telling me to sell it lower. I thought it was buy low, sell high. Technically, sometimes these barriers have to be breached to really understand that, the worm is turned a little bit, and, trying to catch knives or, get the, every once in a while you can get the high print, and you can pat yourself on the back and be a hero. But again, that's just the probability game. That doesn't work with the probability game. So again, we look at these, I look at the internals severely, and I try to figure out, also looking at some of the leaders. I mean, you look at Apple. Let's just take a look at Apple. I mean, a lot of times, what the breadth calculations will do is they're not weighted. So when you have things, and sometimes these events happen like this. I remember, was it last fall? I believe it was last fall. I think it was last fall. We had, some breadth calculations start to get mixed up around weekly unfair highs. When I say mixed up, I mean some were negative, some were positive. Intermediate, let's just say negative, weekly was positive. And then we started coming off of that inflection point up top on the weekly. We started breaking down the daily. Both were negative. Then it was a full onslaught of shorting opportunities. And that happened near market run-up highs. So what that means is that there was a disconnect between players in the pack. The leaders were kind of driving the market up, possibly, or vice versa. The leaders weren't driving the market up, and the other ones were. I don't remember what the case was in that instance, but you have a disconnect going on that the breadth calculations are telling you because they're non-weighted. Now, a lot of market managers will exclusively, or fund managers, excuse me, that we deal with, will exclusively, because they don't trade a lot and they're not trying to probably churn somebody's account, they're looking for a return, they will exclusively look at when it's time to hedge their portfolio, and they will strictly go to the weekly and daily based on the different time frames they want to hedge the portfolio. And they'll say, well, you know what, from November 2012, there was a very rare instance where we might want to go to cash or hedge the portfolio. All right. Now, since, I will admit, we've had more gyrations in 2015 than, and as you can see, there's the price action there. Gyrations meaning long-term negative breath relative to long-term positive breath. But these portfolio managers, a lot of them will just strictly look at this feature only in the scanner and say, wow, the internals are changing. They'll look at the ETF sectors and they'll say, I need to be going to cash right now. I'm going to save myself some points. Here is the long-term weekly crossover back in the middle of February, right? So, okay to get back in the water. Markets moved up. That's been great for them. There hasn't been a lot of disturbance on the long-term weekly breath, crossover situation. We had a little bit of a pullback there, as you know. But they're also looking at those index inflection points. This is a little bit too rich for my blood to kind of stay in trades, in this manner. But again, they're not really trading that often, and they're trying to say, and by the way, another thing there's so many things I always want to talk about every day. We will take, let's just say they have 183 stocks that they have in their portfolio. A lot of times we'll just take a programmer, they'll say, hey, wow, I want to do a breadth calculation for my own portfolio as if it were an index itself. And then we'll kind of create a little mousetrap for them, give them breadth calculations that they can have on their desktop for their portfolio and see how their portfolio breadth is actually acting relative to the index itself or the sector itself. And what that does for them is to see, on a profile type, net profile basis, whether they are, in the right or in the wrong relative to what, that equation outputs. Okay, let me read the DIN here and catch up. All right. Nobody has any comments to what I say ever. Thank you. All right. So let's take a look at a couple of stocks. We're going to take a look at Apple, a couple of leaders. Remember, the internals look pretty good. Here's Apple. So, and let me just show you something here. Let's go back to the daily. All right, so, we've been in a decent situation where it was okay to sell resistance, sell breakdowns in Apple for a while. We talked about this 93.81, getting back up into it and being able to look at this as a shorting opportunity. When we get back above there, we kind of have to wait, get stopped out, wait for other things to happen. And these other things to happen are an inflection point at 99.44. We've actually pierced that. The market doing what it's doing is not helping any short situation on this particular stock. But what I want to show you is not only have we breached the unfair highs on the daily, we've actually kind of, gotten above these areas on the weekly too. So Apple on a long term, this weekly close above this 98.5, 99.5 general area is a big deal. And to come in here, it's very similar type situation as the S&Ps. We close above, we break technically. And remember, like if you go back in time, this is the first time we've broken profiles. This was a lot of trading opportunities in here, especially on the intermediate. But as we broke below 125, this is the first time we've broken back above profiles since almost a whole year ago, actually, July 2015. So as we look at this, significant event, S&Ps are doing what they're doing. Might see some more upside in Apple here, and not really a situation to short at this stage. Thanks, guys. We'll be right back.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
Catch Larry Pesavento, a 40-year veteran trader. He uses pattern recognition, Gartleys, butterflies, ABCs, and Fibonacci in order to trade these markets. Trade what you see. Next on TFNN.
Hi guys, we're taking a look at Apple. We were talking about, leaders of the pack, heavily weighted stocks, and the scanner breadth calculations kind of being a non-weighted, consolidated calculation. I look at that, really intently when we get to these major inflection points. So when we're at the S&Ps, we're looking at this up here. I mean, we may fall through on this retracement. We may fall through this 83.73 DMZ, but on a long-term basis, you've got a collection area here, right? So you're supposed to be buying support when these internals are doing this. There's no anomalies going on. Everybody's happy. Excuse me, all the stocks are happy. Not every trader's happy, but as we look at this, it is what it is. And this, like we've talked about, scary situation for the shorts. Now, going back here, and I don't have a lot of history here on this particular chart, but when we were down in here, there was another thing that we were talking about. I was eating a little crow here, trying to catch a bid on some of these things on the intermediate. Let me go back to that time frame here. Eating a little crow back in this area, right, to the left of the chart here. And why is that the case? Because, we were looking at how the U.S. markets were acting relative to the rest of the world, all right? So in the rest of the world, it's not like this is something you discovered. I mean, the rest of the world was looking at the U.S. markets as, wow, this is the relative strength trade. Everything else is going to hell in a handbasket. The U.S. market really hasn't come off that much. So we were looking at this, trying to use these inflection points to catch a couple of bids here. Sometimes you got to sit on the sidelines. Sometimes, but these internals really started changing to positive territory. I remember when this happened back in, the 1850s. I think we really got some clear signs getting back above 1890 again. And then we kind of spun around here and found support, and, that's been the name of the game. But sometimes we look at relative strength relative to what else is going on in the world in general. So again, you got a lot of things to think about, and sometimes the more you complicate things and more factors you put into it, the more wacky it gets. But every morning we're just trying to put some pieces together for you, let you see what the broad strokes are. Dollar coming off right now, and kind of flushing below this 95.65, 95.53. I don't know if this is going to affect the U.S. equities market in a big way, but again, it's interesting how now it's almost like, wow, let's try to use that to get out of some of these longs in crude. I haven't been a fan of being long crude oil up here. Especially since Goldman Sachs announced it was time to get long crude oil. And so as we look at this, now, we talked about what's the risk at this stage from 48 to 50. We'd been talking about the risk is to be long, and we were basing that on a couple of things. We were looking at the Canadian dollar, we were looking at the Russian ruble, we were looking at the XLE. And as we look back at the XLE in this case wasn't really trying to make new highs as crude was making new highs. So again, the support area on this is 65.27. We're pretty still, let's see, what are we doing pre-market? 66.60. So again, it wasn't the rosiest situation for other indicators, other markets to really predicate the concept that crude was going to go higher. So now, in my opinion, you take a look at crude oil, you've got a little bit of a stop-oriented situation. You can play above 49, and we could revisit 46 very easily on crude. Thanks, guys.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
This is TFNN.